Welcome to our presentation on In Re Marriage of Hein. I am Catherine Kirkland. I am co-presenting in this program with Jim Schaefer. Our format is different from most presentations that you encounter. We will present the most important points in Justice Franson's appellate decision verbatim. Jim and I will periodically insert commentary to highlight important concepts for both the attorney and the family law forensic accountant, and will explain how those points can be used in the presentation of admissible evidence in any particular case.
I am Jim Schaefer, a family law forensic accountant. I will be presenting illustrations of how a particular point may affect the calculation of income available for support for both parties. These illustrations will assist forensic accountants in preparing their reports and testimony at a settlement conference or an evidentiary hearing. Catherine will expand on the law where appropriate and will provide strategy for counsel in presenting the evidence from the forensic accountant.
An off-screen avatar will read the relevant portions of the Hein decision. The graphics and commentary are not part of the decision. Preliminarily, the court's decision clarified two important evidentiary issues, which were important as part of the basis for the holding in the decision. Justice Franson's words identify the issues and clarify them.
On the question of the burden of proof and the rebuttable presumption that the gross income stated on a parent's tax returns is correct, we conclude such a presumption, if it exists, does not extend to the tax returns. In this case, here, the self-employed father's businesses are organized into two wholly separate corporations, one tax-paying entity and one flow-through entity. The corporation's operations are intertwined, and their total assets exceed $5 million. In such circumstances, we conclude the burden of proving that the expenses claimed on the tax returns constitute expenditures required for the operation of the businesses is properly allocated to the self-employed parent who controls the corporations. We therefore reverse the trial court's order denying the request to modify child support.
The clarification of the burden of proof about tax returns when the returns are done by a party or by a tax preparer under the control of the party, the burden of proof is squarely the responsibility of that party. Previous cases have never dealt directly with this issue, but have made rulings based solely on the facts of the individual case. Now there is a clear and unequivocal rule to be applied to all future cases. It is not limited to farming cases.
We therefore reverse the trial court's order denying the request to modify child support and remand for further proceedings to determine the father's income available for child support. This appeal raises issues about a self-employed parent's annual gross income for purposes of determining child support under the statewide guideline. The mother contends the trial court did not properly determine the father's annual gross income under Family Code Section 4058 and, thus, erred in calculating the amount of child support owed. The trial court allowed the depreciation deductions claimed on the federal income tax returns of the father and his corporations to reduce his income available for child support.
The Hein decision clarifies the difference between the IRS rules for depreciation for income tax purposes and the family law rules for depreciation. The two types of rules differ in both method and amount. For IRS purposes, there are two depreciation computation methods. The first is straight-line depreciation, where the cost of equipment is depreciated over a period of years with the same amount in each year. The second category accelerates depreciation deductions in early years and reduces in later years. Most businesses use this method for depreciable assets other than real property. Now back to the decision.
After the trial court issued its decision, we decided the question of statutory construction involving depreciation. We concluded a self-employed parent's depreciation deductions for motor vehicles did not constitute expenditures required for the operation of the business for purposes of Section 4058, Subdivision A, 2. We now extend that statutory interpretation from motor vehicles to depreciation deductions for equipment and other assets used in the self-employed parent's businesses. The term expenditure describes an actual outlay of cash. Claiming a depreciation deduction on an income tax return does not require an outlay of cash and, thus, does not reduce the funds available for child support. Footnote 2. The parties have not briefed, and we do not address, whether the money a business spends acquiring a capital asset, such as the $500,000 used to purchase a Cessna airplane, might qualify as an expenditure required for the operation of the business. Also, we do not address whether an acquisition of a capital asset could constitute special circumstances, or whether increased value or depreciation of a capital asset could constitute special circumstances. Martin is a self-employed farm owner and manager and has been licensed as a commercial pilot for over 20 years. He is the sole shareholder and president of Hein Ranch Company, HRC, and Martin Hein Ranch Company, MHRC. The parties stipulated that Martin's average wages and salary for 2013 and 2014, as reflected on his personal income tax returns, was $7,760 per month, not including any contributions to a pension plan or employee benefits. The parties disagreed about the amount of additional income that should be included in his net disposable income for purposes of calculating child support. An important component of the formula used in the statewide Uniform Guideline for determining child support is the total net monthly disposable income of both parties. Section 4055. Monthly net disposable income is usually computed by dividing the parent's annual net disposable income by 12. The annual net disposable income of each parent shall be computed by deducting from his or her annual gross income the actual amounts attributable to items listed in the statute. Section 4059. Those deductions include 1. State and federal income tax liability, 2. Contributions to the Federal Insurance Contributions Act, 3. Amounts paid for retirement benefits if participation is required as a condition of employment, 4. Health insurance or health plan premiums for the parent or any children the parent is obligated to support, 5. Spousal or other child support actually being paid, and 6. Certain job-related expenses. Section 4059. Section 4058 defines a parent's annual gross income to mean income from whatever source derived, except child support payments actually received and income derived from any need-based, public assistance program. The non-exclusive statutory list of income sources includes compensation in the form of salaries, wages, and bonuses. It also includes investment income such as rent, dividends, and interest. The income generated by a parent's ownership of a business is included pursuant to subdivision A.2 of Section 4058, which provides income from the proprietorship of a business, such as gross receipts from the business reduced by expenditures required for the operation of the business. Besides the money from a business's gross receipts less required operating expenditures, a business owner might receive other things of economic value through the business. Subdivision A.3 of Section 4058 addresses such items by providing that income includes I. and the discretion of the court, employee benefits or self-employment benefits, taking into consideration the benefit to the employee, any corresponding reduction in living expenses, and other relevant facts. In this case, Jessica's arguments about Martin's income available for child support pertain to his ownership, i.e., proprietorship, of his businesses and, therefore, involve the application of paragraphs 2 and 3 of subdivision A of Section 4058. Jessica contends the trial court abused its discretion by failing to include depreciation deductions claimed on the company income tax returns in the funds available to Martin for child support. In her view, the depreciation deductions claimed do not constitute expenditures required for the operation of the business for purposes of subdivision A.2 of Section 4058. She supports this view by referring to the statutory interpretation adopted in Asfaw v. Wolbrahan. In Asfaw, the court considered the statutory text and concluded that depreciation of rental property may not be deducted from annual gross income when calculating child support.
When entering amounts to support software, think of the input as a two-step process. First, you get the tax liability correct by claiming the depreciation within the business net income. Second, add back the depreciation amount under non-taxable income as a family law adjustment. Now back to the case.
The trial court statement of decision acknowledged Jessica's argument that the court should back out certain claims for depreciation made on the corporate returns and attribute that as income available for support and her reliance of SFA to support this treatment of depreciation. The court noted the depreciation deduction in SFA related to rental real estate and the present case involved deductions for the purchase of vehicles and equipment. The court stated that Jessica has not cited, nor has the court found any subsequent California decision, that expands the holding of SFA beyond the specific facts of that case. Accordingly, the trial court rejected Jessica's argument that the depreciation deductions were not expenditures required for the operation of the business for purposes of subdivision A-2 of Section 4058. The statutory interpretation adopted in Rodriguez for deducting motor vehicle depreciation appears to apply to the equipment, vehicles and Cessna airplane at issue in this case. The party's appellate briefing, however, does not address how this court's interpretation and application of Section 4058 to depreciation in Rodriguez affects depreciation deductions claims by Martin and his corporations. Rather, Martin's brief quotes the trial court statement that Jessica did not cite, and the trial court did not find any subsequent California decision expanding the holding of SFA beyond the specific facts of that case. Although Martin's counsel attempted to distinguish Rodriguez during oral argument, she has not persuaded us that subdivision A-2 of Section 4058 should be construed differently depending on whether the depreciation relates to rental real estate or to vehicles and equipment. Furthermore, we have not identified any reason to deviate from our analysis and decision in Rodriguez. Thus, we continue to interpret expenditure, as used in subdivision A-2 of Section 4058, to mean the actual outlay of cash or other consideration. In addition, we continue in the view that depreciating an asset on a company's books and claiming a depreciation deduction on federal income tax returns does not involve an outlay of cash with a corresponding reduction of cash available for child support. Stated from another perspective, we do not conflate 1. The outlay of money used to purchase a capital asset, i.e., a capital cost or expenditure with 2. The accounting entries, such as depreciation, that occur after the acquisition of the asset and do not involve the actual outlay of funds in future years.
I just heard the words accounting entries. If you are working from company-prepared financials for a private business, do not assume that depreciation entries have been made for the current year or for any year. Depreciation in non-CPA prepared financial statements is a wild card. On the other hand, income tax returns should consistently show depreciation deductions for the calendar or fiscal year. Now back to the decision.
Consequently, we conclude the interpretation of Section 4058, subdivision A-2, adopted in SFA and Rodriguez should be applied to the depreciation deductions involved in calculating the income Martin had available for child support. These deductions include expenses under Internal Revenue Code Section 179. That federal tax provision authorizes a taxpayer to elect to treat the cost of acquiring certain business assets as a cost, i.e., a current deduction, rather than depreciating that cost over the life of the asset. In summary, the depreciation and Section 179 expenses claimed by Martin and his corporations should have not reduced his income available for child support. As a result, the matter must be remanded to the trial court to recalculate Martin's gross annual income and redetermine his child support obligation.
Before we conclude this program, I have a few questions. The first one is, does the Hein decision apply to child support only? What about temporary spousal support and permanent spousal support?
The answer to that question is the calculation of income under Family Code Section 4058, including the principles set forth in this case, can be used not only for child support but also for both temporary and permanent spousal support and for any other financial issue where the income of either party or both parties is needed, such as attorney's fees and costs and sanctions.
I recognize that this decision does not apply to the year of acquisition. However, the court seems to imply that if $100,000 of machinery is acquired in year 1 and $75,000 in year 2, counsel is free to argue the purchase price in each year is an allowable deduction from income available for support. Do you agree?
The rule for any business expense is outlay of cash. In some years, businesses may purchase new equipment or replace outdated equipment, both of which would require that the business actually make an outlay of cash. That outlay of cash would be a business expense.